the people that are printing money are buying the one thing they can't print, and that's gold and silver. Geez, inflation is roaring. There's a war. Gold and silver have lost their counterintuitive presence.
What caused the $7 dip last week? The usual shenanigans, lies, lies, and more lies.
Miners going directly to China at a huge premium. You sell 10 million ounces at a $10 premium. You just made $100 million above the Western price. Have a nice day. Have a nice retirement. Holding your wealth in dollars is like holding a melting ice cube.
If our central banks are the bad guys, and I believe that's true, and are buying all this metal, what does that tell us?
A lot of people figured it's never going to go this high again and sold. And I would argue this is where bull markets begin.
Is it a good time to buy, hold ETFs? When silver breaks out, we can't even sell our physical for spot.
That is a function of the CME group raising margins, an environment where the central banks have been buying gold and silver, pushing the price higher, higher, higher. New Fed Chair Warsh wants to change the metric again to accommodate an inflationary system. Who in their right mind would buy it?
What caused the $7 dip last week? The usual shenanigans, lies, lies, and more lies. There was no real fundamental reason why silver should have been down $7. There was nothing happened. No one stopped using silver as much as we certainly do. The solar industry did not put a pause or a hiatus on what they're doing in manufacturing. They didn't find that we can use copper instead of silver. All of that, by the way, I had a couple of clients call me this week and ask me about that. Bullshit. That's what I will say. There is no other metal that we know of today that does the job like silver does.
Well, copper is close second, but look, there's a shortage in copper too. I mean, the world is looking for hard assets, and the big players understand that they can misdirect the public with price. And even you all who understand the reasons to buy it, get just, what do you get? You get dejected, you get distracted, you get misdirected, you get like angry. The counterintuitive nature of price allows the people who are painting the tape to bring out this emotion in people. Is exactly, I mean, they're very good at it. They understand that is exactly the time to knock it down, because they don't want to be challenged for something that everyone at the highest level is racing to get right now. And you can see that by the delivery numbers. You can see that by the import numbers into China, where they have a roughly a $9 to $10 premium right now over the Western price.
Silver dropped $7 while industrial demand stayed intact, and that disconnect should worry anyone trusting headline-driven markets. Andy Schectman notes that China is still paying massive premiums above Western pricing, even as paper markets signal weakness. That divergence tells you institutions may be accumulating physical metal, while retail investors get psychologically shaken out through volatility. When price falls without a corresponding collapse in demand, it often signals positioning rather than fundamentals. Next, Andy Schectman exposes why delivery data completely contradicts the panic narrative surrounding silver's recent sell-off.
To incentivize the dummies here, the big traders, to sell what is not nailed down, not selling the government stockpile, but selling private stockpiles directly to China, or even mints going directly, miners going directly to China at a huge premium. You sell 10 million ounces at a $10 premium. You just made $100 million above the Western price. Have a nice day. Have a nice retirement. That is what is happening. And I think that's something that people need to understand is that the biggest money in the world is racing to accumulate. And the way that they can misdirect the mainstream and the analysts who use technical analysis to tell you, well, that's not a good idea. They paint the tape to violate moving averages, to fall when it should be going higher, to make you all say, geez, inflation is roaring, there's a war. Gold and silver have lost their counterintuitive presence. Why would you own it in that respect? That's what they want to do. And yet the import numbers, the deliveries across the globe should tell you, well, that's not really the case. They're fooling you. And this is the whole concept of the art of war, how to beat your opponent without throwing a punch. And that book is read in every major business school on formulating arguments, in law schools, on corporate hierarchy, in CIA at West Point. They all are mandated to read that book to understand the whole concept of misdirection. And the easiest way to misdirect the public is through price, because no one looks under the hood. They just look at the price.
Markets are screaming weakness while physical silver quietly moves east at premiums most investors never hear about. According to Andy Schectman, miners can make an extra $100 million simply by bypassing Western pricing mechanisms and selling directly into stronger foreign demand. That creates a dangerous illusion where technical charts appear bearish even as real-world supply tightens underneath the surface. Retail traders react to red candles, but institutions track flows, inventories, and delivery pressure instead. Next, Andy Schectman reveals why price itself may be the primary weapon used to misdirect public perception.
He's right. All right, there's a couple of good questions I want to go over. Alan Livingston, 71. If our central banks are the bad guys, and I believe that's true, and are buying all this metal, what does that tell us?
It tells us that the people that are printing money are buying the one thing they can't print, and that's gold and silver. It tells us that the big money understands where real value is, because holding your wealth in dollars is like holding a melting ice cube. We say that all the time, but it's true. If you look at since 1971, it's lost 99.5% of its value. And we talk about the house prices. In the last 21 years, since 2005, house prices in middle America have doubled from 240 to 500,000. But gold was $455 an ounce then. And if you divide that into 40,000, it's 530 ounces thereabouts. So your house doubled in dollar terms, but in gold terms, it's lost over 500% because those 530 ounces are worth over $2.5 million. It buys you 5 houses fully furnished at $500,000 apiece without paying any interest. Gold is the neutral reserve asset by which everything is valued. In the United States, we have a hard time with valuations because we value things arbitrarily. It's against the dollar. Measure any asset you own in gold terms, and you'll see prices are falling. In dollar terms, they've all gone up.
If the dollar lost over 99% of its value against gold since 1971, then most retirement projections are built on distorted assumptions. What Andy Schectman is highlighting is that central banks continue buying the very assets they publicly downplay, while simultaneously expanding fiat debt systems. A house may appear more expensive in dollars, but measured in gold, purchasing power tells a completely different story. Savers focused only on nominal gains risk missing the silent erosion happening underneath inflation-adjusted reality. Next, Andy Schectman unravels why measuring wealth in dollars may be the biggest financial illusion of this cycle.
At Fazdal says, is it a good time to buy, hold ETFs? We found out that when silver breaks out, we can't even sell our physical for spot, but we can always sell an ETF for frictionless profit.
All right, let's first let me address the first part of that question. In 36 years I've been doing this. Is it Fazdal?
Fazdal.
I have never seen Fazdal. Never. I think I remember his name from Liberty and Finance.
But I think he might have been on last week too.
He's also on Liberty and Finance, and I've never seen bids like this. Never, ever. And the other end of the spectrum, had you sold it during the pandemic, you would have received massive premiums where junk silver was $9 over spot bid. Silver Eagles were $12 over spot bid. Gold Eagles were almost $200 over spot bid. This is the other end of it. This is the antithesis of what we saw during the pandemic. But in normal times, everything, with the exception of maybe kilo gold bars and 1,000-ounce silver bars, trades at a premium to spot. This is an unusual time. Now, as far as the ETF is concerned, first of all, you're paying a 50 basis point management fee to BlackRock and JP Morgan in the SLV GLD world. You can never take possession of it. So sure, it's frictionless, but that's the only benefit of it. You're taxed the same way as if you sold physical, and you can never get possession of it.
BlackRock and JP Morgan collect management fees, while many ETF holders assume they own something equivalent to physical metal. Andy Schectman's argument suggests this unusual disconnect between spot pricing and real-world premiums signals deeper stress beneath the paper market structure. During crisis periods, physical holders often see premiums explode, while ETF investors remain tied to synthetic exposure they cannot redeem directly. That distinction matters when liquidity tightens and trust in counterparties starts breaking down. Next, Andy Schectman reveals why the current bid structure in silver may be unlike anything seen in decades.
Now let's pretend instead you either held it, you have no fees, or you store it in a Brinks facility like we were just talking about. The storage fee, which will be in almost every case less than the management fee, is also tax deductible, goes to the cost basis. In my opinion, the only ETFs, and they're really not ETFs, they're trusts that I would ever own would be PHYS and PSLV, the Sprott physical trusts, but none of it compares to owning the real thing. And I think you're right. It's been very frustrating over the last 12 months to see bid prices where they are. That is a function of the CME group raising margins and an environment where the central banks have been buying gold and silver, pushing the price higher, 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 higher. These are the most well-informed traders in the world, but that information has somehow skipped the mainstream to the point where any of you, and Fazdal, if you tried to talk to your family or your best friends about owning gold, they'd think you have horns coming out of your head, right? And so I think it hasn't really, it's a weird environment where the price goes higher, has nothing to do with the retail side of things. It has everything to do with the biggest money in the world. Now that will spill over and premiums will normalize.
Yep.
But over the last year, as prices have been going up, even though our business has been very strong, it's from you all, not from the mainstream. You're the pimple on the elephant's rear end. The elephant hasn't turned around. When the elephant turns around, premiums go parabolic because you have just as much buying as you do selling.
Retail investors are still skeptical, even as central banks continue accumulating gold at historically aggressive levels. This is where Andy Schectman's thesis shifts from price action to participation, because major bull markets often begin before mainstream money fully notices. Rising margins, tight physical supply, and weak retail engagement create a setup where institutional demand dominates market direction quietly. Once broader participation returns, premiums can accelerate far faster than spot prices themselves. Next, Andy Schectman exposes why the real breakout may start only after the public finally rushes back into metals.
A lot of people figured it's never going to go this high again and sold. And I would argue this is where bull markets begin, when the weak hands and the people who want to sell have sold into much stronger hands. And I think you will see this anomaly of stupid premiums.
And I'm gonna add one more thing to that Andy didn't mention. When you sell your ETF, anytime that you make a transaction, that will generate a 1099. It will be reported no matter what by your the company that you own.
At 28% collectible rate.
Correct. With physical metal, as long as you're under the requirements, which is 5 1,000-ounce silver bars and 100-ounce gold bar, or 3 kilos of gold in one transaction, which is typically held in a 24-hour period. There is no dealer reporting.
Well, let's highlight the word dealer.
Dealer, yeah.
No dealer reporting. We're not going to ask you. It's your responsibility.
Every law-abiding, tax-paying citizen is supposed to report anything, whether it's metal, whether it's Beanie Babies.
Why do you keep saying Beanie Babies? You have a thing for Beanie Babies.
I have a bunch in my garage.
Listen to me. Don't ever. You just told the whole world you have Beanie Babies.
If this liquidation phase continues for another few months, many investors may sell hard assets right before the strongest part of the cycle begins. Andy Schectman notes that weak hands historically exit near the beginning of major commodity bull markets, not the end. What rarely gets discussed is how paper exposure creates automatic reporting trails and tax friction, while physical ownership operates under a different structure entirely. That difference matters more during unstable monetary periods than most portfolios account for. Next, Andy Schectman reveals why tightening physical supply could eventually overwhelm today's paper pricing mechanisms.
VA Girls 40, I keep hearing Mexico is not exporting, also that they want to refine their silver and not sell doré. What have you heard?
I haven't heard that, but it would make sense. That's nationalization of assets. I think you'll see that. And, during the pandemic, as an example, the U.S. Mint was the model of inefficiency, and they didn't produce anything. And if you type in on Google Bix Weir Jack Sermon, who runs the Silver Eagle program and has since its inception, he admits in a 3-part interview to Bix, I almost fell off my chair listening to it, that he was told by Janet Yellen, his superior, who is the Treasury Secretary at that point, to only produce as few amount of Silver Eagles as possible without creating a global backlash. He said that. They purposely limited, which is illegal.
Yep.
It says they have to produce as many as is demanded by the public in the charter that formulated the law. So in other words, it was easier for me to get Perth Mint kangaroos and UK Britannias and Eagles as one of the 27 authorized resellers of the US Mint, who I know everybody. I couldn't get them. My point is, at what point, if things get nuts, does Australia say, screw it, I'm not sending this to Western retail investors. We'll keep it here at home, or the UK or South Africa or Austria or Canada. So yeah, I think that you will see countries nationalize, and the first line of action would be to nationalize mints. I think Mexico did that, and I want to say it might have been with nickel or some other base metal. They've already done that. And quite frankly, as the largest producer of silver in the world, as a country that isn't super well off, they ought to do that. I don't know that to be true, but it wouldn't surprise me.
Governments publicly defend free markets right up until strategic resources become politically critical. According to Andy Schectman, pandemic-era mint restrictions and potential export controls reveal how quickly national interests can override open market assumptions during supply stress. The deeper issue is that many investors still believe access to precious metals will remain frictionless, even as producing nations rethink domestic resource security. When countries begin prioritizing internal reserves over exports, retail buyers are usually the last to know. Next, Andy Schectman exposes why sovereign control over silver supply may become the next hidden inflation accelerant.
Gold terms, I read Bill Bonner today. Bill Bonner is an amazing writer. And he said that gold has lost 99.1% of its value since that day. Excuse me. The dollar has, measured in gold terms, measured in gold terms, the dollar has lost 99.1% of its value measured in gold terms since that day. So in essence, it's the baby boomers got to receive the bulk of all the benefit of that, of that devaluation of the dollar, because the wealthy ones were able to put it into assets. Assets went to the moon. What did you tell me today about $1,000 invested?
Yeah. If you had put $1,000 into advanced micro devices 10 years ago, today it would be worth $111,100 and something dollars. So it was an 11,000+% return on your money over the last 10 years.
Yeah.
So it's a pretty big game.
Yeah.
I mean, it's a pretty nutty game. And I'll tell you, the other thing that I found interesting was I watched a piece with Rick Rule. And of course, they asked Rick where he believes gold will be and silver will be in X amount of time. And, you know, Rick, he doesn't kind of play around. He just says, listen, my whole point is in 10 years, if the US dollar loses what he believes will be at least 75% of the purchasing power, without a doubt, he sees gold no less than at least doubling or tripling in value. So we're talking about at least a $10 number, but more likely than not, 15,000.
The dollar officially remains the world's reserve currency, yet measured against gold, it has already lost over 99% of its purchasing power since 1971. What Andy Schectman is highlighting is that asset inflation was never accidental. It became the mechanism used to absorb relentless currency debasement over decades. Stocks, housing, and commodities surged not because money became stronger, but because fiat purchasing power steadily weakened underneath the system. Investors sitting entirely in cash may be defending nominal stability while silently losing real wealth every year. Next, Andy Schectman unravels why gold's next revaluation cycle could expose how distorted modern asset pricing has become.
Why? Because generally speaking, and I speak of this, Andy's always said it, there is no bull market like a commodities bull market, and no bull market, especially like a gold bull market.
Why?
Why what?
Why is that the
case?
Well,
that I'm going to let you tell it.
Because as the price goes higher, for most of you, some of the people who bought metal along the way have to sell for various reasons, and others bought it for maybe not the same reasons that some of you do. See a big picture, so to speak. They've already let go. But most people will say, my God, I'm not going back into the dollar. Why would I want to do that? That's why it validates the reasons you went into metals to begin with. And so the secondary market, in essence,
dries up.
And then you're reliant upon 6 major mints and a handful of refineries and private mints that run out of product in a
That's it.
Isla, sweetheart. No, we know he's here. Thank you. So yeah, that is something that is true.
And what Rick went on to say was, he said everything in terms of these bull markets become exacerbated. So when that bull market happens and when we hit the 10,000 or the 15,000, generally speaking, we overshoot those numbers substantially. So, he wasn't shy to say, can we see 20,000? Sure, we're going to overshoot. If it's a 2x or a 3x and we're at 15, why not?
Markets usually peak when investors rush to take profits, but gold bull markets behave differently once confidence in fiat starts breaking down. Andy Schectman's argument suggests the real squeeze begins when holders stop converting gains back into depreciating currency altogether. That creates a supply vacuum, where secondary inventory dries up just as new demand accelerates through the system. Most mainstream analysts model gold like a normal commodity cycle, while ignoring the monetary psychology driving it underneath. Next, Andy Schectman reveals why precious metals bull markets often overshoot far beyond what conventional valuation models predict.
All markets, in my experience, have a pendulum effect. They overshoot, they come back
both ways.
They'll undershoot, they'll overshoot, they'll find fair value at some point.
Silver Buffs wants to know if we can talk a little bit about the bond market craziness. Today yields were down just a little bit. But we're still sitting at the 10 years, roughly at around a 4.49 right now.
I mean, who in their right mind would buy a 10-year Treasury paying 4.5% when inflation? We know the numbers that they measure inflation with, and the new Fed chair Warsh wants to change the metric again to accommodate an inflationary system. Who in their right mind would buy it? And so what you're seeing, the reason rates have been going higher, especially in the face of a war in the Middle East, where every time I've seen that in all the Gulf wars where oil is affected, rates go way down as people run to the supposed safety and liquidity of a 10-year Treasury. They've gone up considerably. I don't know, 60, 70 basis points since the beginning.
Yep.
Who in their right mind would own it? So what you will get when you look at the fact that China has cut their bond holdings in half, and much of the world who owns Treasuries, Turkey just sold all of them. They're all selling their bonds in favor of a neutral asset that has killed the bond market in terms of performance, that is gold with no counterparty risk.
Bond yields are climbing during geopolitical instability, and historically that kind of divergence signals deeper stress inside the financial system. This is where Andy Schectman's thesis shifts, because foreign governments are reducing Treasury exposure even while public narratives still frame US debt as the ultimate safe haven. China and Turkey cutting holdings while gold outperforms bonds tells you capital may already be repositioning ahead of a larger monetary transition. Investors relying solely on fixed income could face purchasing power destruction disguised as stability. Next, Andy Schectman exposes why the bond market may be far more fragile than equity investors currently realize.
You'll get yield curve control, where the Fed comes in and somehow quietly, maybe through shell corporations in the Cayman Islands, if we're supposed to believe that they're like the third or fourth largest holder of our treasuries, they're buying treasuries to suppress the price of, or the yield from going higher. And what that does is it creates more and more and more inflation. And inflation is not going away. So this is a problem they have. If they come in and accommodate, or QE like everyone would assume, then you reignite the inflation and inflation goes parabolic. If you tighten from these levels, you're going to see the banks and the insurance companies in real trouble real fast the minute that 10-year breaks through 5%. But look at Japan. Their rates are the highest they've ever been, in the 10 and the 30. And half of the gain that we've seen in all of these markets has been because of the Japanese carry trade, which it's all but shattered.
Right.
Surprised that hasn't created more problems. Quite frankly, they're holding the whole thing together with baling wire and bubble gum.
That's it.
The bond market is where all the problems lie. And
the bond market is way, way bigger than the equities market.
The Fed says inflation remains manageable, yet bond markets are behaving as if monetary control is already slipping. Andy Schectman notes that yield curve control would likely require indirect Treasury purchases and additional liquidity injections just to prevent rates from spiraling higher. That creates a dangerous trap, where tightening risks breaking banks, while easing risks reigniting inflation across the system. Most investors focus on stocks, but the real systemic pressure is building inside the far larger global bond market.